Good afternoon, ladies and gentlemen. A very warm welcome to another virtual seminar organized by Seminars and Conference Committee meeting and Taxation Committee meeting of the Institute of Certified Management Accountants of Sri Lanka. The National Professional Management Accounting Body in Sri Lanka, incorporated by an Act of Parliament, CMA, has always played a lead role in this digital environment to update the knowledge of its members by organizing continuing programs, professional development programs for its members and students. The presentation on the Inland Revenue Amendments Bill will be conducted by a panel of experts in taxation. The session will begin with a presentation on the IR Amendment Bill, including brief explanation delivered by Mr. Athula Ranavira, Managing Partner of Ranavira Associates. This will be followed by a presentation on the SSCL Amendment Bill with a brief explanation by Mr. N. Sulaiman, Tax Partner at Ernst & Young. Thereafter, Mr. Suresh Pereira, Principal, Tax and Regulatory at KPMG, will deliver a presentation on the recent amendments to the Port City Act and the strategic development projects and their effects on foreign direct investments and overall economy. Following this, Mr. N.R. Gajendran will discuss the rationality of these changes and their impact on the overall economy. The session will be concluded with a Q&A session with the experts. I wish to invite all participants to send their questions at the end of each presentation to be answered at the Q&A session. I also warmly welcome CMA President Professor Lakshman R. Watavala, Vice President of CMA Mr. Hennayaka Bandara, other council members, members of CMA, invitees, ladies and gentlemen. Before we commence the proceedings, we will like to take a photo of all speakers and invitees and would request all them to open the video for a quick photograph.
Yeah, I think if everyone can open the video, that would be fine. Suresh, Gajendran. Gaje, you have to open the video. Right, okay. Okay then, yeah. Look straight so that, Gajay. Is it okay? Is, this one is there, I can't see him. Shanti? Okay, wait, Mr. Sulaiman is also coming in. If, Mr. Can you open your... Mr. Can you open? We want to take a photograph. Can you open your video?
One moment, Dr. Professor Van.
Yeah. Oh. Okay, it's a little dark. Okay. Okay, Shanti, okay, can you take the photo? Okay, Shanti? Right, okay, I think we will now leave it at it enough time. Yeah. Okay, Rakshika, but
commence the program, I have pleasure in inviting Professor Lakshman R. Vatavala, President CMA Sri Lanka, to deliver the welcome address and introduction to the today's topic. Over to you, sir.
Good afternoon to all of you. Our eminent panel of speakers, our council members, vice president, and all the participants who are present for this very important webinar on the recent tax changes in laws connected with tax and investments. So I must first of all thank our eminent speakers for making themselves available to speak at this webinar and to give this information, the valuable information of the amendments to the bill, and of course also which includes the Inland Revenue Act Amendment Bill of 2026 and the Social Security Contribution Levy Act Amendment Bill of 2026, the Port City Act and Strategic Development Project Act recent amendments. These are some very important legislation that will be taken to Parliament. One of the areas, of course, is the tax changes are mainly to increase the taxes, and I think the gift tax, there is a change, but I'm sure our speakers will be able to give the details of this, as this can also have maybe impact, which will have impact on our taxpayers, plus also on the economic development of Sri Lanka. So then the other area, of course, is the Social Security Contribution Levy Amendment Bill of 2026 and the Port City and Strategic Development Project Act, the recent amendments that have been taking place in order to attract foreign direct investment. Foreign direct investment is a very important area for Sri Lanka because we are really depending on the foreign direct investment mainly because that we have to pay a huge amount of debt that is there. So the foreign direct investment will help us, but also that it will also enable us to take more development, economic development. Some of the areas that I just want to mention is that before this Strategic Development Act came into place, it was the Board of Investment that really handled all these investments, and also the tax incentives which were approved by the Parliament. And according to that, there was a transparent policy available to all investors to ensure that according to their investments, they were able to get the tax incentives. So at the initial stages, I think, I don't know for whatever reason, a new Strategic Development Act was put into place. And as a result, I think some of the investments that were even due to come to the country had to be debated in Parliament, and this was really not something that the investors would have liked to. But later they have made changes, and one of the reasons but I feel that the Strategic Development Act came in is that it could be altered to the whims and fancies of those who were close to the power. This is not a very good way to attract foreign direct investment, and I think now they have put the strategic development law, which will give the various tax incentives that are applied. But again, there are two different areas. One is the Board of Investment, where within the country it takes place, and then the Strategic Development Act, which is coming under the Port City. So again, there can be problems, and one of the main things that they say is, of course, splitting a business and taking it to another area, which even in the BOI is not permitted, because since I was also there as the chairman and the director general of BOI. I've seen what has happened, but the most important thing is the stability. Stability and, of course, what we call the one-stop shop, and where we are able to get things done. So when this Board of Investment was initially created one of the main reasons was it was under the Excellency the President, because everyone knew that if it is under the President, then things will get done. But for a long period, it has been changed. As a result of it, the BOI lost its powers and the respect that it had earlier. So I do hope that now it will be under the president, because it is not only the president. The president used to have what is called the a cabinet subcommittee, which used to meet every week to approve investments. Because I remember the time that we were setting up the 200 garment factories program, the amount of problems we had, but as a result of the measures that were taken, BOI was able to act as a one-stop shop to get the cabinet subcommittee approval, to get the cabinet approval, and of course, where all the government servants were able to carry out their duties without any problems, and the responsibilities were laid down as to what should be done. So I think we need to go back to that sort of thing, because it's really not the incentive that is really material, but it's how things are being done, how soon one could get a project done, and also at that time it was for the export industry. Now, once the infrastructure area was brought in, one has to be very careful and to see, and of course, according to the Strategic Development Act, how you can define a strategic development project. Now, here again, there can be so many pros and cons, and maybe they are talking of value creation. But if these are for the export industry, then of course the investor will be able to look after all these things, and we do not have much problem, because export means they will bring in foreign exchange to the country. But there are infrastructure projects. Again, the infrastructure projects could be for the export industry, like the development of the port and many others that are there. And also it will not affect the local people. So these are some of the few comments I thought that I should make with the experience that I have had, because I've seen the time when the BOI was under the president and how things worked, and also the time that it was under a minister. Then things were entirely different. It was not like the president giving an order and getting the approval from the minister. But here, when the ministers give, there is always, maybe the various difficulties in getting approval. So that's why I said that with the experience that I have had, that if we follow these, and of course the policies, and maybe have I think central bank has done a good job on the exchange rate and keeping it steady, which foreigners are looking at, and of course where the customs and others will also have to cooperate, so that the goods could be imported and exported without any problem. So these are some of the comments I thought I should make, but I'm sure Mr. Suresh Perra is expert on this, the new act, and what have been included there, and I'm sure he will be able to give all details. So once again, I must thank all our participants, because CMA is a national professional management accounting body, and we are doing whatever possible for the benefit of the our members, and also the corporate sector and the others who come for these webinars. Today we had almost more than 700 who had registered, but always it's about 50% when it comes for them to attend it. But with the speakers who are there, because they are really giving their services free of charge, we are not charging you anything. So you are getting free knowledge, which will really benefit you and also your organizations that are there. So I would like you to always give support to the CMA. Now we are having this week on the 14th, a career guidance and job fair. So if you have any of your maybe people who want to join the CMA, then also in the companies where we are giving registration based on their experience, they can really make use of it. Because today, the only way for us to develop is through the education, especially the professional education, which includes not only the academic area but the practical area. In fact, all our speakers here are those experts, both having the academic and the practical experience. So you can see that from their performance itself as to how well the professional accountants, professional management accountants are performing. So thank you very much for everyone and also our eminent speakers. I'm sure that all of you would be able to explain in great detail and also in a simplified manner, which will help all our participants to follow it. Thank you and all the very best.
Thank you, sir. Next on the agenda is the presentation on the IR Amendment Bill with brief explanation by Mr. Atula Ranavira. He is a managing partner at Ranavira Associates and an expert in the field of taxation. Over to you, sir.
Thank you, Professor, and all the organizing committee and other my friends, the resource persons. Right. Now, today my area is to cover the inland revenue bill part. I will cover the inland revenue bill part. Right. For that, I will share a document. I will share a PowerPoint presentation which I have prepared for that. I think you all can see this document. Right.
Yeah, we can see.
Yeah. Now in this document, there are about 16 slides out of these things. Now I have analyzed the Inland Revenue Amendment Bill content in different headings. Now in my one, in this document, first I thought of seeing the government budget estimates of 2026 to see the requirement or the importance of tax money to the government of Sri Lanka. Then analysis of government revenue during past periods. Actually, I have extracted these two documents from the last budget as well as Fiscal Policy Department information. Then thereafter, I will move towards the Amendment Bill 2026. In that, I have categorized that in under 12 headings, 12 paragraphs, right? Now, if you see the government budget estimate of 2026, when we see the tax money, the total expenditure, it's rapidly increasing, almost 20.5% of the GDP is there. Then how we are financing that? The main financing way is the taxation, right? Rather than explaining this, now if you'll see the government revenue in the recent past, now if you'll see 2024, still 2025, the final information are not available. Therefore, I included 2024 one. In that, the tax base, the income tax collection is almost 1.1 billion and 25,000, 1,200,000 in billions, right? Now, it's a fairly big amount, the income tax collection. Then tax based on the domestic consumption, like VAT, SSCL, import duty and all, record a greater amount than the income tax collection. Then there this plus the import almost that is the highest amount. Anyway, at the end, total government revenue is a material amount. Out of that, main contributor is the import duty, then VAT, SSCL, then income tax. Now we'll move, seeing that the requirement of this income tax, and we will move to the Inland Revenue Bill 2026. This particular bill issued on 24th February 2026 and not fixed a date, not listed the parliament discussion date. Once they list, there may be, if there are any objections, anybody can go to the Supreme Court to object. Then if they are subject to those objections, subject to the Supreme Court determination, the Parliament can pass this. Now, in this bill, there are almost 44 amending clauses to the Inland Revenue Act. 44 clauses are there to amend the Inland Revenue Act. Some of these things are minor amendment just to improve the clarity of the existing law. And some of these things are very important changes. Now we'll see the important changes. One important change is with relate to the tax rate changes with relate to capital gain. Now investment capital gains, for the time being at present, the companies are paying at the rate of 30% investment capital gain tax. On investment capital gain, the companies are paying 30%, all other persons are paying 10%. Now, as for this budget, the trust's rate 10% is proposed to increase to 30%. Then, NGO's rate also proposed to increase to 30%. NGO rate is also proposed to increase to 30%. Then, in the case of individuals and partnerships, they propose to increase from 10% to 15%. Right. This increase will happen upon legislation of this law. Generally, investment capital gain, charging of investment capital gain is badly affecting to the investment ability of the investors because it badly affects to the disposable income of a person, savings of a person. As a result, ultimately, it is indirectly affecting to the economic development of a country. Right. Now we'll see the next point. Income tax computation related changes. Income tax computation related changes. I have picked the items relating to income tax computation and shown those things in this slide. One item is gain on disposal of motor vehicles. Actually, this is not a new thing. It is a new clarification only. Anyway, when a business entity even or an investment entity dispose a motor vehicle which is not used for the business as a depreciable asset. As you know, in the case of investment income, no depreciation, capital allowances are not there. But in the case of business, source of income, the capital allowance is there. Now, in the case of business, when there's a motor vehicle, which is not considered as depreciable asset, unless it is a hiring type of a vehicle or a goods transport, then it is not a depreciable vehicle. When we dispose a non-depreciable vehicle, the gain on that is a casual nature. Therefore, under Section 8, anyway, that is excluded. Anyway, it is excluded under Section 8. But a lot of people are asking this question again and again. In the case of individual, in the case of business entities and all, a lot of people are asking that may be the reason why they thought of include a clause for that, to say in the section 8, to say that that particular income is a casual nature income, hence it is excluded from tax. Anyway, this is the normal situation, but now it is documented. Right. Only thing, now they are proposing to document this with effect from 1st April 24. That is wrong. Actually, they should backdate it from 1st April 2018. From the date of effectiveness of this law, it is in operation. Already it is in operation. Therefore, I think they should backdate this date to 1st April 2018. Right. Then, the second point, new exemptions on life insurance policy receipts. Now, as you know, for the time being, we have only one exemption, that is for senior citizens. When a senior citizen receive a life insurance maturity proceeds, or whatever the life insurance, the benefit, which is with the tenure is more than 10 years, senior citizen is receiving, the tenure is more than 10 years, then under third schedule to the Inland Revenue Act, it is exempt. But in this case, there's an unfair situation for a life insurance because it is an assurance policy. When it comes to an assurance policy, we pay contribution to them not only for the risk coverage, but also as a saving. Then in one day, that person or the dependents will get the benefit out of that. Then that benefit comprises partly the income and partly your own contribution also. Therefore, but unfortunately, with the current tax law, lot of people are paying income tax on the maturity proceed of life insurance policies which are not exempted under the third schedule, which is not fair. One can argue that in the case of business and investment, this is an investment income. In the case of an investment, you can deduct the expenditure incurred in generating of that income. But I know majority is disregard this expenditure. Anyway, now they are proposing a receipt upon death, maturity or surrender be excluded from assessable income. That's a good proposal. That means not only your contribution, but also the benefit, additional benefit what you are getting is to be excluded from assessable income. Then there won't be tax on that. But annuities, pensions, business-related payments will continue to be liable. Then the third one, tax credit on receipt of arrears salaries. Now, some occasions, especially the institution connected with government, those employees, the promotions and all are getting delayed. As a result, sometimes they get a promotion with backdated salary arrears. Now, by the time, suppose in 2025-26, you get a salary arrears, which is relating to 3-4 years back, for a period last 3 years. Then the correct method is to amend each of those years' tax return. But in the section 21 of the Inland Revenue Act, it says remuneration to be accounted for tax purposes on receipt basis. As a result, normally we tax it to the current year because of that. Right. Then there's an unfortunate situation in that current year tax rate may be a higher tax rate than the applicable year's tax. Therefore, now they are proposing an amendment for that, a tax credit mechanism on salary arrears received in different year to prevent double taxation. Now, for that, they are proposing a tax credit mechanism. It says the tax credit is equivalent to A. Then, how to arrive A? That is, B minus C, B is the current year's effective tax on that areas. That means in the current year, we calculate the tax by inclusive of that employment income, take the figure, tax figure, then we exclude the employment income and calculate it again. Then the difference between these two is the effective tax on that employment areas employment income. Then C, the tax on arrears if tax it in the preceding year. Suppose preceding year, the maximum tax rate was 24%, now 36%. When we apply the previous that year's taxation, we have to calculate what would have been the tax in that year. Then we have to deduct that from the answer P. Then we are getting the net credit what we are getting. Anyway, this is welcome because it is important. Then the qualifying payment things. Qualifying payment carry forward facility, certain qualifying payment, especially the qualifying payment donation to the government and donation to the fund established by government. If we donated a figure more than the assessable income, then we can't claim the entire amount in the current year. As a result, now they are allowing us to carry forward that to the next year and so on and claim it. Then we'll move to the next item, deductions and allowances. In taxation, to arrive the assessable income, there are various deductions and allowances. Now, with relate to those items, I have summarized those things here. Relaxation of the methods, certain methods, especially under Section 10, as you know, there's a cash transaction limitation. At present, there are 4 ways of making a payment to allow for tax purposes. Those are the account pay check, account pay bank draft, credit card, debit card, or electronic payment. Into these things, that means you can't make a payment in cash if the amount is greater than 500,000. If you make it cash or open check, it is not allowable. But under this, now they are introducing a thing. If you deposit that money into the recipient's bank account, then that is eligible for this deduction. That is, that then for the time being, there are 5 ways. Then with this, there are 6 ways of doing that. Then head office expenses. Now, when an international company operates in Sri Lanka, the international expenses may be charged into the local company. Up to now, the limitation was because people can manipulate. Therefore, the limitation was that expenditure should not be more than 10% of the assessable income of the local company. Now, in addition to that 10%, they are introducing another thing. Actually, this is a clarity also. It is limited to the actual cost also. If the actual charge is lesser than the 10%, then actual charge to be claimed. That is the clarity improvement. Then enhanced capital allowances. Now, as you know, for the past so many years, we are not getting the foreign direct investments due to various reasons. Now, to promote this, as well as to promote our people to go and invest more and more in industries and all, for the time being, the enhanced capital allowance lowest investment limit is $3 million. Now, they are proposing to introduce another category into that for the investment in between $250,000 to $3 million for them to give 100% enhanced capital allowances. This has to be a new undertaking. This is good because this is a needy thing. Sri Lanka need foreign direct investment and anyway the investments. Then export-oriented payments. When we take the payments with no Sri Lankan source directly, that means overseas source, if incurred for export of goods and services, that expenditure to be allowed for taxation. Right? Because the source is overseas, but even the source is overseas, the expenditure should be allowed. Next category, withholding tax exemptions. The withholding tax exemption, there are few areas covered with that. Independent service providers. Now, as you know, under Section 85, independent service providers, if it is an individual, there's a withholding tax of 5%. If it is resident people, if it is non-resident people, there's a withholding tax of 14%. Now, this is, they are covering this for that 5%, the coverage area is, at present, it is very limited. Therefore, now they are bringing 29 new categories into this, because some people are misusing this section because the areas covered is limited. Therefore, now they have listed new 29 items into this. Right? 29 new items into this. Right? I'm not going to read all these things. Right? Yeah, this is a good thing because it can limit a lot of manipulations, and also government will be in a position to improve their tax collections further. Because this is only a withholding tax, where the credit is there against the final tax. Only thing, no directions on this. Then the interest exemptions. The interest exemption also they introduce relaxation of deduction of withholding tax on certain deposit interest. On what? On deposit interest paid to resident individuals with no taxable income. Suppose I don't have any taxable income. I have only few interest income. We'll say my interest income is per year is 1.5 million, which is below 1.8 million. No taxable income. Now, in that case, why should I pay withholding tax at the rate of 10%? There's no purpose. No, government should collect it and refund me. Therefore, for that type of people can get a self-declaration direction, self-declaration to the banking institution, financial institution, and avoid deduction of that tax. That's good. Then free certification. Now, this withholding tax certificate, as the agent to the government, these financial institutions should issue withholding tax certificates to the depositors. But in certain cases, some entities, they charge these things. Heard that they are charging some fee. Therefore, now it is mentioned that there shouldn't be charges on that. It has to be a free. Then fifth item, installment tax computation and set return changes. Installment tax computation, not like in 2006 Act, in this current Act, they have not given the estimation basis. We can estimate the way we want. And as a result, a lot of taxpayers are misusing this section. Therefore, now they are proposing that you have to estimate based on the previous year's actual tax amount. Basing the previous year's actual tax amount, which was there in 2006 Act also. I think that is a good thing. Then, again, foreign tax credit. Now, this is a clarity improvement mainly. What it says is, in computation of installment tax allowance on foreign tax credit to be allowed. If you have some overseas income, if you are including that overseas income for your estimate of tax, installment tax, then from the tax amount, you can allow the credit for the overseas tax credit also, permitted overseas tax. Then the set return with effect from 1st April 2026, that is 26-27 onward, the set return filing is not required. Next item, administration and compliance changes. This is very much important for practitioners. Making TIN certificate mandatory for certain activities. When we engage with various activities, the TIN certificate is required, like registration of a vehicle, buying a building plan approval, and so many things like that. They have listed certain things. Opening bank accounts, building plan approval, motor vehicle registration and renewal, land registration, business registration, share transfers, and credit card applications. For all these things in future, upon enactment of this bill, a TIN number is required. That's good. Why certain people are not paying tax when they are to pay tax? Yeah. Then document submission limits. Now, documents must be submitted within 6 months or 9 months in the case of overseas people from request date. When the IRD requested document, we have to submit within 6 months. That is the maximum time period. If domestic, if it is overseas, 6 months, 9 months. Non-compliant document. Now, suppose we didn't provide these things, then thereafter we can't make use of those documents for judicial proceedings. That's good. Now, earlier this was covered, but newly added, even to tax appeal commission, we can't make use of those documents. Therefore, you have to be very careful to give the documents to the IRD when they request. Then company registration. When a company is incorporated, within 30 days of the incorporation, you have to get the TIN number. Next, senior citizens return filing. In future, they are trying to open the senior citizens to file the returns in writing. Then return filing the exemptions. Now into the return filing exemption, they are bringing the employees whose small interest income is their employment income on which the withholding tax is deducted, and he is having a small interest income per year 5,000 rupees. That person need not to file a return. But I can't understand why it is 5,000 small amount. Right. No return filing refers to Colombo Port City, the filing relief. For Port City entities, no relief, they have to file the returns. Now we will see penalties and enforcements. Now, new penalty, they have introduced some penalties. Withholding agents not complied with the requirements. The penalty, this is the mark is wrong. Penalty not more than 200,000. Individuals providing false statements, penalty not more than 200,000 rupees. This mark is wrong. I'll correct it before sharing. Prosecution of offences, new chapter is introducing into the Inland Revenue Act to cover this prosecution. In that case, they are proposing a penalty or fine not more than 400,000 or imprisonment, or here also this mark wrong, 6 months or both. Then next, the Commissioner General submits a certificate containing tax, interest, penalties to magistrate. That is, then protection from assessment. Protection from assessment. Individuals filing returns with tax paid 120% of the previous year's tax. You pay 120% of, or minimum 120% of the previous year's tax. Then give an affidavit saying that you have done the correct thing, not hidden anything. Then you are getting amnesty for that. What's the amnesty? The protected from amended or additional assessment. Indirectly, this is amnesty. That means the IRD will not dig into your return. But if you have not done fraud or evasion. Next, penalties and residency rules. Golden Paradise visa holders shall not be considered as resident for Sri Lanka taxation. Then overseas employment. Some of our people go overseas on contract more than 1 year to work overseas. For them also, now if that employer is an overseas employer and the employee is a Sri Lankan employee, working in overseas on a contract more than 1 year shall not considered as a resident of Sri Lanka for the period commencing from the first day of the year of assessment until contract is ending. For that period, we are not going to tax those people in Sri Lanka. Right? We are not going to tax those people in Sri Lanka. But there are few conditions within bracket. I have given those things to manage the time. I will move forward. Next, 3 more slides. Special industry provisions. Certain special industry, life insurance business. Now, the profit calculation methodology, there's a small change into the methodology of profit calculation. Then in the case of unit trust, as you know, unit trust is paying tax on their ultimate profit. But there's now in this unit trust, now we invest in unit trust, and some unit trusts are not providing proper information to the investors for their own taxes. Now, hence, it's creating a lot of issues nowadays. Therefore, they are introducing a section like this: failure to serve certificates on unit trust holders within 5 months of the year end. In certificate, what are the things to be included? Income, exempt amounts, withholding tax amount, and other related information specified by the Commissioner General. That type of a certificate to be given to the unit holder within 5 months of the end of the year of assessment. Then if they're not provided that, result in unit trust being deemed normal resident company for taxation. That's then they will be badly affected. As a result, now they have to give these certificates within 5 years. Next, National Gem and Jewelry Authority, as we know, when the gem mining people send gemstones in a National Gem and Jewelry Authority auction, they have to pay 2.5% withholding tax, which is the final tax on that particular business. Then this is a very low rate. Therefore, people can do various manipulations on this. As a result, now to strengthen these things, now Gem and Jewelry Authority should provide monthly information within 30 days. April month 1, by 31st May, they have to provide that information to the IR. Then charitable institutions. Commissioner General may grant tax credit to charitable institution to give a benefit to the charitable institution equal to the tax payable by the charitable institution established for the provision of institutional care for sick and needy people. Institutional care for sick and needy people. If the Commissioner General is satisfied that the cost of those care services borne by the institute, if the institute borne by the expenditure, then the Act is proposing to give a tax credit for the institute. That's good. Next, information sharing. Now, under section 100, the Inland Revenue Department provide our information to third parties, listed the other parties. Into that other party listing, they are proposing to add 3 more. Director of Financial Intelligence Unit, Inspector General of Police, then the Sri Lanka Accounting and Auditing Standard Monitoring Board. These 3 entities also to be included into that. Then next item, interest write-off. Now, this is a small amnesty. This is the amnesty without the using of the word amnesty. Interest on underpayment and late payment under the following will be written off if principal tax amount and the penalties are paid within 6 months of the Act coming into operation. Now, under these things, Section 157, then the Surcharge Act, and this something missing here. Then the Surcharge Act and the Finance Act. Under the Surcharge Act and Finance Act, there's a if there are any taxes to be paid, we can pay those taxes. Then the interest, there's 1.5% per month interest, automatic interest is there. That automatic interest can be waived off. It is automatically. Right. Next, exemption, the last slide, the exemptions and sunset clauses, these are minor things. Government, assistant, private school. If there are private school running with the government assistance and following the government circulars, then for those things, we enjoy some tax exemptions. Yeah. Then, old account concessions under section 203 connecting with old act concession. Now, there may be some companies enjoying the tax holidays or lower tax rates under the old act. Now, they are trying to stop this by 31st March 2025. Any company who is enjoying a lower tax rate or tax holiday under the 2006 Inland Revenue Act will be ceased enjoying that by 31st March 2025. Then next one, temporary concessions. Sixth schedule, there are some temporary concessions. That is, the time period is over. Therefore, it says all temporary concessions granted under the sixth schedule is limited to the year of assessment prior to 1st April 25. Now, no more concessions under the sixth schedule. This is to improve the clarity. They are bringing this. That's all. Now, there are some more corrections and so many things, but I included all important things in my note. I noticed one or two small typing errors in it. I will rectify those things before sharing the. Thank you very much. If there are any questions at the end, we can discuss those questions. Thank you.
Thank you, sir. Next on the agenda is a presentation on IR amendment bills. Next on the agenda is recent amendments to the Port City Act and the Strategic Development Projects Act and their effects on foreign direct investment and the overall economy.
I
Done
think
by
Mr. Sulaiman's one, no? Next one. Is it one?
oh,
Okay, next one has Sulaiman's one.
the next on the agenda is a presentation on the SSCL amendment bills with a brief explanation and requirements and effects of indirect taxes into Sri Lanka's business and economy by Mr. N. Sulaiman, tax partner, Ernst & Young, and an expert in the field of taxation. Over to you, sir.
Thank you. Can the slides be seen and can I be heard?
Yeah. Okay, fine.
Okay, so firstly, I'd like to thank CMA and Professor Butterwell for the opportunity inviting me to this session. So I will cover the recent amendments to the Social Security Contribution Levy that has come up and the impacts that may have to the economy and taxpayers at large. So SSCL, there aren't many changes that have come through, but there are some that can have significant impacts to the economy overall. So I'll start with the two latest changes. One is an act that came into effect and certified by the Speaker on 17 December 2025, and that has some retrospective impact. So that is a law. And then we have the recent Social Security Contribution Levy bill that was issued on 3rd March that is yet to be passed in Parliament. So we will cover both. There aren't many changes. So we'll run through it and we shouldn't take more than 10 to 15 minutes. Right. So, sorry. Starting with the act, that is law. The first amendment was the restriction on the exemption of import or local purchase of machinery or equipment for electricity generation. So there was an exemption that was available where the CEB, when procuring equipment for electricity generation, had an exemption, but that is to be removed, where the CEB or by institutions supplying electricity to the CEB, the exemption will cease with effect from 18th of February 2025. So there is a retrospective impact on this. If transactions have already taken place, I think you might have to see how to rectify the impact of it, if at all SSCL has been charged already. Then we have the clarification provided on the supply of petrol, diesel, or kerosene oil. So there is an exemption available for this supply. However, there is a limitation to the exemption and a condition requiring that these supplies be made or kerosene, diesel, and petrol be sold in a filling station. So it limits to that extent only the last leg of the value chain. That is, only when you're pumping at a fuel station, these three goods are exempt. The value chain prior to that, that is from import to maybe processor to wholesaler to distributor, all of those didn't have the exemption, creating additional cost in the value chain. So now this sold in a filling station has been removed, and these items, petrol, diesel, or kerosene, have been exempt from SSCL with no reference to filling station. So throughout the value chain, on any wholesale or retail supply of it, or sale of it, or processing of it, the exemption should apply. And that is also coming into effect from July 1st, 2025. Again, a retrospective impact to all of those in the petroleum industry, which you have to see if charged, how you're going to resolve it. Then supply of financial services. So as you know, there is a VAT on financial services, as well as SSCL on financial services also was brought. So this was a welcome reform in the budget, where they said they're going to consolidate both, or they're going to exempt SSCL. So the exemption came through in this amendment effective from December 17, 2025. However, they brought the exemption with a condition. So you're exempt from SSCL on financial services at 2.5%, provided you pay VAT on financial services at 20.5%. So currently the VAT on financial services is at 18. So unless you pay at 20.5, this exemption doesn't kick in, although it's passed in law, right? So we need to wait now for the VAT Amendment Act, which is also fairly late and overdue now. And we are expecting that VAT on financial services will be taken up to 20.5%. I'm not sure the effective date, because it will probably prospective, because a increase in tax shouldn't or can't be retrospective based on the last ruling by the Supreme Court on a VAT case. So it will be prospective, and hence, until this amendment comes, SSCL and FS is not exempt, because everybody is paying VAT on FS at 18%. So that is the complication with this amendment in the Act. Okay. Right. Then again, the Amendment Act is expanding the definition of transportation of goods and passengers. So as you know, prior to 17 December 2025, exemption was very simple on the transportation of goods, and passengers were exempt from SSCL. The amendment adds to this. It doesn't restrict it in any way. It adds or broadens the scope of this exemption to include services related to international transportation provided by container terminal operators. So their services will also now fall within transportation of goods and services, and will be exempt from SSCL from December 17, 2025. Now we come to the bill. There aren't many, there are no significant numbers, but the impact of this will be fairly significant on the small and medium-sized enterprises, and that was what was presented in the budget last year. The reduction in the SSCL registration threshold which is currently 60 million rupees per annum, is going to go down to 36 million rupees per annum. So that's roughly about 3 million, right? 3 million rupees a month. So this is effective from April 1st, 2026. So the important thing here is it's almost halving of the threshold, right? So a lot of small and medium enterprises will fall into this. So this has a dual impact. One is, of course, the number of smaller entities will be much larger, and hence the broadening of the tax base to some extent. But this will also, on the other hand, be passed on to consumers. So those small shops, those small entities that were serving consumers will also now increase their prices by 2.5%, and there'll be a unlike VAT, SSCL has a cascading effect from import point or manufacturing point all the way to sale. Of course, there is the adjustment to the base where manufacturer pays 85% and then wholesaler at 50, and then the distributor at 25% of sale. But still, it has a significant cascading effect, can ultimately amount to 5 to 6% of turnover when it comes to the consumer. So this will have, I think, a significant impact on cost going up. Plus, if it done right, that means if everybody complies, I think there might be a significant increase in revenue as well as broadening of the tax base, where a lot of people who are not in the net will now be captured. Only issue is from monitoring standpoint and assessing standpoint, with the Department of Inland Revenue has the capacity to go after so many numbers for a smaller amount of tax is the question, and whether technology will be brought in to monitor and implement this is what we'll have to wait and see. So in terms of compliance with this new change, the timeline provided to register is 15 days. So as soon as the amendment is done, within 15 days, you are given an opportunity to immediately register for SSCL in order to be compliant. Otherwise, you'll be considered non-compliant, and there will be penalties imposed on late payment. Right, then we have the other significant change in SSCL. Again, it's still in the bill, not law yet. But this is the movement of SSCL, the charging point of SSCL on motor vehicles, moving from the retail selling point to the import point. And I think the rationale for this was that at the retail selling point, imposition was not done, payment is not being done at the right rates, invoicing is done at different rates, and hence also a revenue measure, I would imagine, because motor vehicles have seen a significant rise in numbers and volume and value. So they're moving the charging point to importation, where the difference would of course be 2.5% now will be on your value of import. That is, I think, the value that is CIF plus all of the duties plus the 10% markup that they put at the customs valuation point, and you'll have the 2.5% coming in on that value. Whereas if it is at retail selling point, since it was exempt from import duty, that is the current law, exempt from import duty at import point, and only at retail point it's sold, because so the retailer will apply 2.5% on the 50% base, because it's a wholesale or retail sale, right? So which one is less, we'll have to wait and see. It's likely that since there's a 50% discount on the retail sale, and you're paying on 100% of the import value, what you're saving is technically the profit markup. So I'm presuming that depending on the value of the vehicle, obviously that the SSL you pay at import point on the full CIF value plus your duties, and the 10% is likely to be higher. So I think we can expect a increase in motor vehicle prices with the imposition of this change from April 1st, 2026. So those are the few changes under the SSCL law. So with that, I'm happy to take any questions at the end, and over to the next presenter. Thank you.
Rakshika,
Thank you, sir. So next we have on the agenda is recent amendments to the Port City Act and the Strategic Developments Project Act and their effects on foreign direct investments and the overall economy. Done by Mr. Suresh Pereira, Principal Tax and Regulatory, KPMG. Over to you, sir.
Suresh, you are there? Oh.
You can see my slides and can hear me, no?
Yeah, yeah.
Right, okay. Let me begin by thanking CMA management for inviting me to do this presentation. And we do have a couple of slides. And let's see. So what I would do is in this one, I will give you an idea with regard to the changes that have taken place, changes that have been introduced to the SDP Act and the Port City Act, and also the two regulations that have been issued under the SDP Act and the Port City Act. Right now, overall, with regard to these amendments, I think we have to say some complimentary things. Actually, these two amendments have been done with the intention of streamlining and bringing good governance to both the Port City regime as well as the SDP regime with regard to the tax holidays. The granting of tax holidays, that is selection criteria for giving tax holidays, the period, and then monitoring the implementation, also other requirements for good governance is what we see when we look at these changes that have been introduced. So I'll say that thing first, and then I'll introduce you all. I'll take you all through the relevant amendments that have been introduced to the Port City regime first, and then the SDP one. So right. So in the Port City regime, there was Amendment Act that was introduced number 1 after 2026. So that's an amendment to the Act. In addition to that, regulations have also introduced via the Gazette notification that was somewhere in September 2025. Right. So there are two things. So now what do we find in relation to the tax holidays? I'm confining to the tax holidays here, my presentation here. So we can see that the tax holidays have been, the length has been reduced, and also now they are dependent on the investment value and the number of jobs, that means the employment generated. So as a range, you can see there's a 25 million investment criteria in relation to the marine area in Port City. But other than that, basically starting from USD 100 million investment and creation of jobs, say 300 jobs is the criteria that we find. There's a range, and depending on that, depending on the investment quantum and the job criteria generation, the tax holiday number of years change. So now what we can see in this slide is, you can see tax holiday. Earlier, there was a 25-year tax holiday for both primary and the secondary BSIs, 25-year tax holiday. Now that primary 25 years has been cut down to starting from 8 to 15 years in relation to the primary business of strategic importance, and in relation to the secondary BSI, that is where most of the general investments flow in. there is no tax holiday. What do we have? We do have a reduced income tax rate of 7.5, and that is also for a period of 4 years. It's coming from the regulation. So we do find shortening the period of the length of the tax holiday, period of the tax holiday from 25 years to bringing it down to, for primary businesses, to 15 years, starting from 8. And for secondary BSIs, there's no tax holiday. It's only 7.5, a reduced income tax rate that we find, and that is also for a restricted period of 4 years. And again, as a good measure, so actually it's I will speak a little bit later about these tax holidays. So it has been done with a good intention, because in the past, we have been absolutely generous with regard to granting tax holidays to attract the FDI. And so many people have been raising questions with regard to the effectiveness of the strategy that we have been using. And now, in order to monitor all this, earlier there was no compulsory filing return, compulsory requirement to file returns. And from the Inland Revenue Officer side, we heard, okay, they expected the companies to, both city companies, to file tax returns, but then legal interpretation or something else. But now there is nothing to interpret. The amending act clearly says that all companies, both city companies, authorized persons, must file income tax returns. So it is a welcome move. It's a part of the good governance. And the tax holidays will not be granted just like that. And before granting the tax holidays, there will be a cost-benefit analysis. Thereafter only the holidays will be granted. So again, that is on theory side, it's what should have been happened. It's something that should have happened a long time back also. So it's a welcome move. It's a good move to do this cost-benefit analysis and really see that whether this granting this tax exemption is going to bring a benefit that is more than the cost. But how this will be granted, how this will be done, who will be doing this thing is also important, because it's their job, the efficiency of their job, the effectiveness of their job, that will decide whether this criteria will be fulfilled or whether it's going to be just another exercise. And another good feature that we find is the holidays, the exemptions, the incentives that are granted are to be reviewed. So there's a 5-year cycle that is introduced, and all the BSI exemption incentives granted will be reviewed. So this is not restricted to the incentives that are coming from the Inland Revenue Act. This will be for other incentives as well. So as we all know, under the Port City Act, sweeping tax incentives could be granted, and those are the things that we are going to look at here. And also, we have to keep in mind in this regulation also, when you look at it, we do find basically with regard to the other taxes, there is nothing mentioned also. So we have to be mindful in relation to that also. So again, there's a monitoring mechanism. There are KPI-based monitoring that has been mentioned as to how it will be implemented. The success of that implementation is critical. And it's not going to be just theory mentioned in the statute or the regulation. Right. So what do we have in relation to the tax holidays, both the primary businesses? So we can see the last one. Let's look at it. Marina. Basically, if the investment is more than 25 million USD and employment job creation is more than 100 jobs, there is a income tax holiday of 8 years proposed or mentioned, and it's also basically you look at the maximum project implementation period of 4 years also there, right? And then we have ABC investment criteria starting from 100 million USD to 300 employees job creations. We do have a tax holiday of 10 years. Then there's a tax holiday of 12 years for, again, 500 million investment and 300 jobs, and 15-year holiday for over 1,000 million USD and 300 plus 300 employees job creations criteria. And SDP, again, as I mentioned earlier, there's an amendment to the Act as well as a regulation also. Just like the SDP also, just like the port city also, investment value and the jobs created has an impact with regard to these tax exemptions. And we can see investment value, the minimum investment value is 50 million, and number of jobs basically ranges from 50 minimum to 250. So in detail, so under the SDP Act also, earlier there was a 25-year holiday. Now it's being reduced to 10 years. So we see the feature, basically these regulations are trying to cut the number of years. This is for the ones that are given for the future projects. And if the project has been granted a longer period, 25 years before this regulation, that will continue. That is not being clawed back. And again, earlier there was no monitoring mechanism, and again there is a cost-benefit analysis and a monitoring mechanism that is being mentioned here. And so regulation again impose sector-specific investment thresholds and the mandatory job creation, as I mentioned earlier. And earlier there was less formalization with regard to that aspect. And again, going forward, we are just like in the port city case, we do find a 5-year review cycle being introduced by the amending act. So which are actually good things, good concepts, but implementation is important. So when it comes to SDP regime, the sector identification. So you get 4 sectors. So infrastructure services, utilities, tourism, leisure, casinos, betting, etc. You can see the investment values linked to the investment values and the jobs created linked to the tax holiday period. Number of years corporate income tax holiday exemption. It's linked to the investment value and the number of jobs created. So when manufacturing is also is like that. That's manufacturing, that's a category B, and then we have the category C coming. There are areas that are coming under the agriculture, education, etc. Now again, you can see it's the investment linked to the investment value and the number of jobs created. Now we have to keep in mind our investment regime incentives are not restricted to the SDP and the port city. And in the second schedule of the Inland Revenue Act, we do have the concept of enhanced capital allowances and the accelerated depreciation, though we don't have tax holidays in the Inland Revenue Act. We did have tax holidays under the old act, but from year of assessment 1819, with the introduction of the new act, the concept of the tax holidays was taken out, and it's only the enhanced capital allowances that we do have. Right, now let's look at this employee remuneration concept, both in the port city and the SDP. I think most of us are interested in this one. Right, so when the port city originally was introduced, any person who secures the AP license, authorized person's license, had to be paid. A company that obtains the status had to pay, or still they have to pay, the salaries of the employees in foreign currency. You can't pay in LKR. It has to be foreign currency payment. So that's an advantage to an employee, specifically the local categories that work there. And not only that, there was a full tax exemption that was mentioned. Full tax exemption during the period of the employment. Now that is being changed. So that change is, I think, important. So what is this change that is being introduced? That blanket tax holiday is being taken out. So if new AP who's moving to the getting established in the port city after the February 1st, 2026, will not be in a position to tell their employees your taxes will be totally tax-free. No, that is not the case. They are liable for taxes if the AP is a new AP that is established after the 1st February 2029. But then what happens to the authorized persons that are there or that have been there before the 1st of February 2026? That's the deadline, right? So the ones who have been if the AP has been AP status had been obtained before the 1st February 2026, what the change that has been introduced is they will get further 3 years to enjoy the employment tax holiday that has been granted. So that means up to February 2029, they will be tax-free for 3 years. There's a transitional period of 3 years. For 3 years, they will be in a position to enjoy their salaries free of tax. Of course, they will be paid in foreign currency. So after the 3rd year onwards, they will be liable. So the common question that people are asking now, today I go and join a port city company which has been there from the beginning, say from before the 1st of February 2026. But I'm joining only now. I'm joining after 1st of February 2026. Would my salary be liable for tax, income tax, or not? The answer is it's not by this criteria. It's not been looked at by looking at the date that you join the port city company. It is when did the port city company obtain the AP license. If it is before 1st of February 2026 and you join one of those old companies, you will be your salary will be free of tax up until 1st February 2029. If you join today, you will not be given 3 years from today, but basically the company will be in a position to pay the salary free of tax up to 1st February 2029, and so up until that time you will be free. But at the same time, if you are joining as an employee of an AP that had been established after the 1st February 2026, of course, you will be liable for income tax, but you will be still getting paid in foreign currency. SDP. Now, in case of SDP, in the Gazette, they used to give up to 25 expatriates tax exemptions, but now those exemptions will not be applicable, and going forward, all of them are going to be liable for tax. So basically, SDP employees, there is no even a transitional aspect of it. They are all going to be liable for tax. And the SDP, just like the port city company, should also file the income tax returns going forward. So with regard to the SDP regime also, enforcement and the monitoring mechanisms have been strengthened, which is good. Which is a welcome thing, which is a good thing. Right. So now I said these two, under these two gazettes and the amendments, there has been a streamlining process of the tax holidays, the incentives, monetary mechanism, etc., which are all plus points, which are all welcome moves, which are good. But the question that we have to ask is, what is the impact of this? Have we done the right thing? So while we have done a good thing with a good noble intention, I think we are still in the dark with regard to what is happening outside Sri Lanka. Because those are the movements, the international tax trends, international tax rules that are changing outside Sri Lanka, we are also caught in it. So when it comes to the attraction of the FDI competition, we do get LBW if you're not aware of what is happening. So to me, what I see is, while we have done positive things, we do display a global disconnect. So what is this global disconnect? So now what is happening is, as we all know, we have heard of this thing called base erosion profit shifting. I'm sure most of us have heard this thing. And so many things happening in relation to that. But I think what is relevant for us to express this within a few minutes is, there is this thing called the global minimum tax of 15% that has been, that is sweeping, that is going across the globe. And there's a mechanism that has been introduced, and that mechanism, though we have not signed to the Pillar 2, though we have not endorsed the Pillar 2, we are also affected due to the mechanism that is being introduced. So let me quickly get and give you an idea with regard to what is this mechanism and how that is affecting Sri Lanka's FDI playbook, right? So the companies that are in groups that earn more than 750 million euros in their financial statements, group revenue, where it's more than 750 million, they fall into one basket, and those are the companies that are going to get affected by this new scheme that called the that's subject to the global minimum tax of 15%. So at the same time, there are investors who are investor companies that are not falling within this category. That means their groups do not have euro 750 million annual revenue. So how do you calculate this thing? There are ways. Basically, you look at 4 years backwards, and out of the 4 years, at least 2 years, this criteria should be fulfilled. Then only basically you say that you're falling within this kind of a group, and you are going to be subject to the GMT 15%. Right. So how does this work? So these big companies, whether they like it or not, wherever they earn, in relation to the money that they earn, profits that they earn, they have to pay 15% effective tax rate. Not the statutory tax rates, the effective tax rate. There's a formula to calculate it. So how it works from the Sri Lankan perspective, let's say one of those big companies are going to invest in Sri Lanka, and we calculate the amount of tax they are paying in Sri Lanka. So if you give them a tax holiday under the SDP, the ETR, of course, will be 0 in Sri Lanka. So if that's the case, we feel investor is getting a benefit because they're not paying tax, but in actual fact, that is not the case. Amount of taxes that the Sri Lankan government is not collecting, which is meant to be a benefit to the investor, this big investor, is being, according to the mechanism, will be collected in another country, usually in the parent company of that investor in Sri Lanka, parent company, provided they have adopted the relevant rules. The relevant rule is income inclusion rule under these globe rules. And if that parent company, let's say in our case, Malaysia has parent companies in Malaysia, and the Malaysia has introduced that rules, enacted that rule. If that's the case, the money that we are not collecting in Sri Lanka, but money that is due to the Sri Lankan treasury, will be collected by the Malaysian government from the parent company in Malaysia. So in other words, though we are not collecting it in Sri Lanka by giving a tax holiday, what happens is that becomes an effect, a donation to the Malaysian government. Sri Lankan government is foregoing taxes, donating money to the Malaysian government. Right? So now, if for whatever reason, if the parent company's jurisdiction country, let's say the Malaysia, has not enacted this rule called the IIR, if that's the case, still, if the Malaysian company has let's say a subsidiary in another country where they have enacted IIR, income inclusion rule, then the money will be collected. Sorry, not IIR, but it's called the UTPR, under tax profit rule. It's enacted in Singapore. Malaysian company subsidiary, that government, Singapore government, can collect it from that subsidiary in Singapore. So there's a lot of terminology, etc. here, but that in effect, what happens is, though Sri Lanka is not collecting the money, we are giving a benefit to the investor. That benefit given to the investor cannot be enjoyed by the investor because it's being absorbed in another country where the investor is carrying on business. So that's why we call it a donation. Now, the first thing is we need to stop that thing. So how do we stop it? Within this globe rules concept itself, we can stop that by first endorsing and getting into the system, Pillar 2, and then enacting in our parliament the rule called QDMTT, qualified domestic minimum top-up tax, and in which case, though under the Inland Revenue Act, we are not collecting this top-up tax, this tax amount could be collected under the QDMTT Act. Therefore, and that results in the taxes paid in Sri Lanka going above 15% effective tax rate, and therefore there won't be a, how to say, benefit that we are giving to the investor will not be collected by another country, but it will be collected by the Sri Lankan government itself if we enact this. But we have not endorsed. I don't know that we will be going into this Pillar 2. If we don't do that thing, what happens to the Sri Lankan economy? Of course, there's a donation happening. We need to check. We have an option without going to the QDMTT itself without endorsing the Pillar 2 to do that. So how do you do that thing? We have to identify these big companies that are subject to the GMT 15% and sit and negotiate the tax holidays that we have granted in the past with this to these companies, because these two companies are also not very happy, because though they have not the benefit that we are giving to them, they can't also enjoy, and it is being collected in some other country. So they are also equally unhappy. So we can sit together and negotiate and cut down that tax holiday, reduce it, and maybe invite them to pay a certain amount of tax, and that will result in them paying the taxes in other countries, and that will be given to the Sri Lankan government. So how do you buy in them for this compromise? So we have to also give something in return. So there are certain tax credits that could be given. There are certain other incentives that could be offered to them, which they can enjoy, what are called the Pillar 2 incentives, Pillar 2 compliant incentives, and that's a mechanism that we should follow immediately before going to the QDM. Of course, then there are other non-fiscal incentives that also they will be welcoming. Anyone will welcome those. And as a last resort, maybe in the future, we may be looking at enacting QDMTT by signing into the Pillar 2. Right now, when you take Sri Lanka is a little bit unique. We do need the big investors. So if you want to get the big investors, this is the game that we need to play. But at the same time, we need the small investors also. So who are the small investors? People who don't fall within the basket of this 750 million who are below that. And for them, still the tax holidays, reduced tax rates, what are called the profit-based incentives, still are attractive. So Sri Lanka need to redefine our investment strategy. So we should have one basket of incentives for the small investors and another basket of incentives for the big investors based on the QRTCs and the SBIE exclusion linked incentives. So that's what we call the two basket strategy, and most of the other countries have gone into this trend. If you look at Ireland, if you look at the countries that are there, say Singapore, so many of them, Vietnam, etc., all have basically been amending their FDI strategies starting from 2023. So we are now in 2026. We are late, but not too late. Still, we can basically go into this different techniques to look after our tax base in Sri Lanka. So within a short period, I tried to explain. I hope you managed to get something out of it. So that's it from my side, Professor.
You, Suresh.
Hello.
I think, Rakshika, yeah.
Thank you, sir. So finally, on the next agenda is a discussion on rationality of these changes and their impact on the overall economy by Mr. N.R. Gajendran, a senior partner at Gajma and Company. Over to you, sir.
Is my audible, Lakshman?
Yeah. You can
Yeah.
hear you.
Yeah, thank you, Lakshman, for inviting me for this. And my role is to see the impact on the economy of this, particularly the main impacts arising from the Inland Revenue Bill, and also maybe I could touch on the Fourth City Amendment, SDP amendment is required. Basically, in vernacular, in Tamil, they say Arna Kanji, Palang Kanji. That is a kanji, that is this porridge. These days, kanji is a food to break fast these days. If that gets cold, it's a sort of expired food. Now, if you see this Inland Revenue Bill, it is going into a number of pages. It's almost big as the main act. It is arising from February 2015 budget proposals. Now we are in March 2016. This law will come into effect in 26-27. And most of the provisions are, this is where when it's, whether these delays in legislation lawmaking is for credible governance. Today's, if you see the front page of the newspaper, this Mark Tucker, the chairman of AI, Sir Mark Tucker, he's telling the investments will flow. In summary, if you read what he has said, flows to countries where it can be trusted. There is credibility is there. There is no reversal of consistent changes in policy and regulations. So now, the first thing that happens when you legislate delayed legislation, you end up with retroactive provisions. Retroactive provisions are you are passing the you're changing the past tax liabilities for past transactions. Retrospective amendments are you on the past transaction you impose future taxes. Now here, if you most of the amendments are coming from 25-26, there are relief provisions, which I am not against it. But if you are going to impose taxes going backwards, that is retroactive and which is not recommended. Any retroactive legislation is not permitted even under a constitution unless otherwise is going to be for national importance and effect. So any of these provisions, if it's taken to courts, they will have before enactment, there will be an issue. But if it is enacted, it will apply. I can mention two of the retroactive provisions which will have far-reaching effect is on these reserves. On thin capitalization, first of all, we brought in thin capitalization rules are bought only for related party transaction world over. We are not concentrating on related party transaction, but you are saying if your capital is thinly capitalized, that is, if it is undercapitalized, you are going to disallow a portion of your interest expenditure even paid to an unrelated party who will be paying tax on that. Now, who are the people who are going to get affected by this thin capitalization rule where they are saying the courts have decided that if any reserves, if there are negatives, so losses incurred, that is not a negative reserve. You don't take it as a negative reserve. You take only the equity money pumped in and the reserves are positive. There is no negative reserve concept. So now if by chance a company has introduced equity of 100 million stated capital, and if you have losses incurred 150 million, there will be, it will be zero, negative. So now all interest will be disallowed. Most of the SMEs are affected by this, and they're going to be affected backwards from 25-26. Their already year is finished. Because if you disallow, already they have been affected by the financial crisis, DITFA, and they have borrowed it, they will end up paying profit. So for example, if the interest claimed is 100 million, and if the profit is 40 million, you'll end up 60 million profit of 20 million to pay. Already they can't afford to pay. So this is a retroactive amendment. In similar way, life insurance business is also having a retroactive amendment, because now from 25-26, if by chance the life insurance policy, what the bonuses and dividends that is paid to the policyholders will be treated as company's income tax liability. So that is a retroactive provisions, which is not good for long-term investment. For investors, if they are aware that these provisions are going to come, how can we have sustainable long-term investment is my question. Then moving on to section 72, which was mentioned, I think, where if there is no source in Sri Lanka, payment arising without any source in Sri Lanka, only an export company can make a deduction. I wouldn't know why this provision is brought in. Even now, any expenditure incurred in a business to produce income should be allowed. Whether there is a source here or outside source, there is no question about it, should be allowed. Now, because you are bringing this provision, there can be situations where, which is not an export-oriented business, if there is a source expenditure with the foreign source, also which has no source in Sri Lanka, whether it shouldn't be allowed. Why should it not be allowed if that is the case? Because there is a specific provision allowing this section. I wouldn't know whether there was a problem on this, for this section has to be brought in. Then going on to the head office expenses, earlier there was a restriction of 10% of the actual expenditure, which was lower, on administration and overhead administration expenses to be allowed. But now it seems to be restricted only for staff traveling, staff remuneration, and also premises charges, that is rent. So now here, if a foreign company comes in, there's also as a branch operation here, you're restricting these operations. So the investor flow, the business coming in, is being restricted by this artificial amounts being only, certain amounts only being allowed and other amounts not being allowed. Of course, up to 10% it will be allowed if it is only staff costs, remuneration, traveling, and rent. That's the way I feel the changes are coming. Some may be subject to correction. Then going on to quarterly taxes, section 19. This estimated returns was a good innovation in this law. What was the problem was that, in calculating the quarterly taxes, you allowed the withholding taxes up to that point of time, but the future one was not estimated to be allowed. But now you have estimated to be allowed to be deducted. So wherever it is estimation come, there is a problem. Currently, what the system is in operation should have been, we should have proceeded with, making minor changes to what was not thus causing a problem. Now, if you go for 1/4 of the previous year's liability, which was true, it was there in the old act, we can't find the tax liability the previous year. After only after the expiry, the first 2 quarters, we can find the liability, because we'll be filing the returns in November. First installment for the current year will be in August 15, second will be November 15. Certainly up to September, you won't know, because that's the final date of payment. So there again, past tax liability also is be an estimate. It is not a definite liability first 2 quarters. So what should have been simplified is, you estimate the liability, take 1/4 of the liability, and deduct all the taxes that you have, withholding taxes you have paid up to that point, and the self-assessment payment. Because the problem why I'm saying is this, if the system, under the RAMI system, the interest is calculation, this interest calculation is a misery. I think people are having a lot of problem on this interest calculation. The system calculates interest, you don't know how it's calculates. Even the revenue officers don't know the calculation. So if it's going to calculate system on these estimates, which can be wrong, then this interest will be a very big problem, because no one is prepared to waive this interest. So the simpler way is, because currently with the estimated tax system, if you pay the estimated tax as the way you have estimated, there is no problem. As long as you pay up to 30th September the taxes, you estimated taxes, and the final taxes by 30th September, there is no problem. I think they should go back to this without because everywhere estimation is coming in now under the new setup. Section 9. Now, normally you want information, inland revenue should information from other institutions, because generally that is the banks, wherever it is, you have to give. Now we are going the Inland Commissioner General is obliged to give into the financial intelligence units, IGP, and the Sri Lanka Accounting Standards and Monetary Board. I don't know what is that is dealing with accounting standards. What does our taxes doing to do with accounting standards? I don't know. So he has to be giving information. Section 102 is a new celebrated section where registration of TIN. Now, TIN registration seems to be solving all evils. But TIN is what? Taxpayer identification number. You have a TIN only if you are chargeable with tax only, you must have a TIN. If you are not chargeable with tax, you don't need to have a TIN. If you want to bring all transaction in, then you bring in transaction with either with the company incorporation number, companies have numbers, or with your identity card numbers. There is no issue about that. But when you bring in TIN, when you go and open a TIN for a transaction or opening a bank account, that is going to give a misnomer. For example, even a person who wants to buy a property who is overseas, why should he have a TIN here to buy? But he can give his passport, or he has give his identity card number that there is transaction in this. The TIN trying to solve all the problem is not going to happen, because how Inland Revenue is going to use this information is another question, whether are they going to use this information just having a TIN. TIN is taxpayer identification number. You have to give effect to that. One of the most draconian provisions which was mildly put across earlier was section 122(8)(2)(a). By this amendment, once this comes into effect, no documents, no information that is given after 6 months, once the Department of Inland Revenue asks for information or a document, and you give it after 6 months, that information or document will be an inadmissible evidence for any other proceedings at the Inland Revenue, Tax Appeals Commission, or Court of Law. That means you are denied of a fair hearing. You are denied of justice. Do you think investors will like this provision? And there are information that the department asks, documents that they may ask, which is simply impossible to give within 6 months. And if it is from outside the country, it's 9 months. It's simply impossible. They ask for reconciliations, which cannot be done, which are not specified. Sometimes they ask information saying you identify all credits in your bank statement and reconcile and show why these bank statements credits are far more than the sales provided in the accounts. They have the cash book, they have the ledger, primary record, secondary record. They want an analysis like this. There is no one preparing accounts like that. So reconciliation is going to sometimes take over 6 months. And if they not happy with anything, the department can issue an assessment. But after the appeal is made, if I can produce my information, facts and figures can be established only up to the stage of Tax Appeals Commission. Thereafter, questions of law when it goes to courts, you can't establish facts, new facts. So you have to establish information, documents, and facts. You can't deny a taxpayer to say, if you don't give this thing 6 months, and that is be all and end all for you, you have no case thereafter. I'm sure this has to be challenged in courts. Otherwise, this law comes in, there will be no rule of law, no fair play justice, no democratic environment, when it comes to after 6 months, everything is over, which is a far-reaching provision. Something has to be done on this. Then we have section 163(4)(a) also. You know, if a tax is due, I don't know when is a tax is due, which is another debate. Tax is due, you can go to the magistrate court direct. You know, you go to the magistrate court, the one place that a taxpayer should not be taken, or taxpayer should be taken as only as a last resort, is the magistrate court. Magistrate court, by the nature of it, is not for civilized people. This is for criminals, you know, for drug addicts, rapists, murderers. And you are clubbed together there when you go there, you know. And if a tax is due, there are other means of recovery. You don't need to first go to the, now as it is done, because under the early act, only on a default notice, there is, you don't make an objection. On the default notice, you go take the tax, take the person for recovery as a last resort to the magistrate. And here also they are saying correctness cannot be questioned. Imagine if you make an assessment and you appeal, department can always say, if they are not deferred the tax, this tax is due. Then you go to the magistrate court. And they are linking that with criminal 291 of the Code of Criminal Procedure Act, which can have far consequences. I'm not sure, I have not researched into it properly, whether though they say you can imprison the person on the Inland Revenue Act, when you trigger section 291, whether imprisonment or incarceration is possible. So this is another section that has to be carefully debated before brought into Parliament for an amendment. Then 175A, service of summons fails. You are going to put a paper notice. I don't know what that purpose will serve. If you serve summons, and if summons cannot be served, the person, taxpayer, there must be enough provisions in the other law how you deal with that in those situations. Inland revenue law is for recovery of taxes. But by putting a service and publicizing the person's name, if the service can bring disrepute, if by his person was not served for whatever reason, if not is not his fault. So you don't need to, you are going to put a press notice, you know. So this is again another provision. These are far-reaching draconian changes to my mind. Whether this will encourage tax compliance, and also we are now craving for investments, foreign direct investments. You know, these are negative signals that might go, a lot of damage control will have to be taken place. Then 185A, it's a new chapter. One page and 1.25 pages. If you don't file a return, if you don't get registered under 102, that is TIN, if you don't get registered for TIN, if you don't file documents or information request by revenue officer, after 6 months, anyhow, you're going to say you're not going to accept it if you don't furnish it. Income tax returns, withholding statements, if you are the withholding agent has not issued, you can be sentenced on imprisonment of 6 months. It looks a little bit of a joke for me. You don't file a return, you don't give information to the taxpayer, Inland Revenue, they can issue assessments. More than that, you can't, even after 6 months, why do you want to send a man to for incarceration, for not furnishing a return or not giving information? This is for criminal offenders. Then section 102, this section, Inland Revenue Act, more than one place uses the word avoidance and doubt. I don't know, lawyers can clarify. Avoidance of doubt, I don't think is used in any of the laws in Sri Lanka other than the tax laws. To my mind, every time use the phrase avoidance of doubt brings about doubt. brings enough doubts with those wording of avoidance of doubt. This 202 avoidance of amendment is totally unnecessary. I don't think there was a major issue. It could have been dealt with all situations without the term avoidance of doubt. Now, on these exemptions was a bad term, right? IMF was against exemption. This government came and swore that they will not bring in back the exemption rules. And even the Inland Revenue Act, there is a provision in Section 9. No statute can give exemptions after the enactment of this law other than the Strategic Development Act. That itself was a disaster. That is one of the acts that the IMF wanted to be delisted, because the minister has a say in that. If you are, as Lakshman said, if you are close to the powers in B, you can get these exemptions. And also, even when it comes to, I think Suresh mentioned about Pillar 2 and all those complicated situations, we need not be worried about much. They are against exemptions or reduced rate. No one is against economic activity. We shouldn't give exemptions because, say, your investment is only 100 million, for example, which is benefiting the country and the employment that bring. But if you give exemption, say, up to 5 years or 25 years or 10 years, and it goes up to ₹1 billion, 900 million is more than the investment. So if you give economic activity-based deductions, like, investments deductions, if you see Amazon last year or year before, they had a 10 billion rupee profit, but they have a tax credit of 157 million. That was refund of 157 million. That is because it's on this in activity-based relief. It was not an exemption, right? So we must move towards that. We can deal with the Pillar 2 effectively, and also there will be no levies and charges by multilateral and even other countries on tax competition, because you have to be competitive for economic activity. So economic activity based relief given is no offense under any of the situation. I believe that's enough for the time being, Lakshman. Time is also up 5 o'clock.
I think there are a few questions. I don't know, Atula, have you? So you seem to have answered some of them.
Yeah, most of the things I answered.
There is something on a vehicle.
Most
Shall I,
of the things I
shall I,
answered.
shall I read that? How does this exemption affect a vehicle importer who already has a social security tax liability, but it is not registered for social security tax?
That is SSCL, no? Yeah.
Yeah.
This exemption, if you're not registered for SSCL, that's what they're trying to catch with this amendment, right? So they're trying to exempt you at selling point, because they are assuming that most vehicle sellers are not registered. So at custom, they'll exempt you at selling point, but they're going to trap you at import point. So import point, nobody can get away, because every vehicle goes through customs and the SSCL be imposed at the customs point. So it's more of a sort of enforcing compliance kind of a amendment. So they'll exempt the selling point, and they're going to open up taxation of SSCL at the import point. So currently import point is exempt. I hope that answers.
I think that is the only one that was there. I think the others have been answered. So as Mr. Gajendran mentioned, we have now come to maybe the closing time. So let me thank all our eminent speakers who have really gone through their areas in great detail, starting from Mr. Atula Ranavira, who had gone through all the inland revenue area, then our Nista Sulaiman, of course, on the SSCL, where he has done his part. Then Suresh Pereira on the SDP, and of course also on the other area relating to all the new tax laws that have come in for investment, and whether that will bring in the desired foreign direct investment. That's what we will have to see. And finally, Mr. Gajendran gave some of the important areas which we may need to take a look at. So let me thank all of you all for your time that you have devoted for us, and I'm sure that this would be very, very beneficial to all our participants who are there. So let me thank them also for all the effort that they have put in, and also our secretariat, Ms. Shanti and Rakshika, who was making the announcements, and all others for all the support they have given. I know our chairman of the taxation committee, Mr. Bhuvendran Gajendra, although he is listening, he is really resting these days. So we wish him a very speedy recovery and that he will be back with us. So let me thank everyone for the great effort that they have put in, and that we will continue the good work that we are doing, and also for everyone for all their support. So thank you, and wish you all the very best. Thank you. And we will now